Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 5th of September. I'm Daniel Lam, your host for the podcast. My 5-year-old boy is back to school this Monday. Unfortunately, though, the typhoon in Hong Kong means that school will be shut today. Not ideal, but the annual typhoon season does bring about such disruptions. Now, a metaphorical typhoon is affecting global risky assets. Just when the markets were celebrating a full recovery since the sharp sell-off in August, we are seeing US equities falling, caused by a certain major chip company potentially getting into an antitrust probe by the US Department of Justice, and more importantly, fear of growth slowdown building up. Now, the latest one is the ISM manufacturing PMI, and that improved in August, but still below expectations of 47.5, and therefore extended a 5-month contraction period. Production fell at a faster pace, and both new orders and new export orders contracted further. So deteriorating demand conditions, combined with a material acceleration in inventories, sent the forward-looking new orders to inventories measures significantly lower. In the meantime, employment continued to fall, although at a slower pace. Last month's 1.1-point acceleration in prices is noteworthy in the context of broad disinflation. This means surging shipping costs could risk reviving goods inflation. So all in all, the ISM manufacturing PMI data continues to show that the US economy is slowing. Compensation growth is weak, combined with falling excess savings and tighter consumer loan standards will stifle consumption growth. Now, we've been turning more defensive in our recommendations. We have recently added US and European healthcare stocks as opportunistic ideas because historically, the healthcare sector has delivered steady earnings compared to the rest of the markets, especially during times of volatility. We also believe that very long-dated treasuries, i.e. those with 20 years plus till maturity, would be a quality way to gain fixed income exposure. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.